Hi everyone, me, small investor here, and today we are diving into Dollar General. For those unfamiliar, Dollar General is an American discount retail chain with roots dating back to 1939. From the last annual report, we can see that the company operated 19,986 stores last year, primarily in the United States, with 3 stores in Mexico. As of December 2024, they operate more than 20,000 stores, and with so many stores, Dollar General holds the title of the largest store chain in the US by number of locations, yet ranks 17th in terms of sales. Let's explore why their stock is down almost 16% from its all-time high in 2022, what's driving this decline, and if this creates an opportunity for us to invest. Dollar General's business model focuses on operating in lower income areas, especially where competition from other grocery stores is minimal. They strategically position stores in the areas where within 15 to 20 miles there are no significant competitors. This approach has served them well historically. Dollar General has managed to grow its revenue every year from 2010 to 2024. However, growth slowed in recent years, with 2024 showing a modest increase of just over 2%. Historically, their net income hovered around 5.5% of revenue, but last year that dropped to 4.3%, reflecting a decline in efficiency and profitability. Analysts project a net income of approximately $1.26 billion for fiscal year ending in January 2025 and $1.32 billion for the next year. To assess if this is achievable, we need to crunch some numbers. Dollar General plans to open 575 new stores in 2025, increasing their total store count to 20,597. Historically, revenue per store peaked at $1.98 million in 2023, the long-term average revenue per store is around $1.64 million, and the lowest revenue per store was recorded in 2009 with $1.25 million. Using this range, we can estimate their total revenue for 2025. We will estimate that all stores planned to be built in 2025 will become operational at the end of the fiscal year. That is why we'll be using current store count for projecting 2025 revenue, and any store that will become operational in 2025 will be a bonus for us. Let's start at the low end of 1.25 million per store. With these numbers, revenue could fall to 25.5 billion, taking us back to 2019 levels. But this won't happen, as the company already achieved 30.3 billion in the first 3 quarters. At the high end of 1.98 million per store, revenue could hit 40.3 billion, and for the average scenario of 1.64 million per store would yield about $33.3 billion in revenue, meaning that company would need only to do 3 billion in last quarter, which is more than achievable. Based on numbers that we just went through and also the numbers of the last quarters, we can reasonably expect that the company will generate around 40.3 billion in this fiscal year, which is exactly the amount the analysts expect Dollar General will achieve. On the profitability side, Dollar General's long-term average profit margin is, already mentioned, 5.5%. We can do the same as we did for the revenue, so let's find a range to work with and see what matches our vision. The lowest net profit margin was recorded in 2009. This is just after the financial crisis. Highest margin was achieved in 2021, and for our average we'll use 3.5 to remain conservative, as the company is in turbulent waters at the moment. This gives us a range of net income from 400 million to 3.2 billion, with our average coming in at 1.4 billion. These projections suggest that analysts' expectation of 1.2 billion in net income is lower than our conservative estimate. If analysts' numbers play out, that means that net profit margin would decline to 3.1%. As the analysts' numbers are more conservative, we'll use their numbers for the net income. Let's also look at EBITDA and EBIT, which gives us a clear picture of operational performance. Both are declining lately, so we'll search numbers at the lower end of projection. For EBIT, we got a range from 2.2 billion to 4.3 billion, with our estimate being 2.3. For EBITDA, we got a range from 2.8 billion to 4.5 billion, with our estimate being 2.8 billion and an all-time low EBITDA margin. As the analysts' estimates are in line with our EBITDA and more conservative for EBIT, we will use their numbers going forward. We perform the same operation for other numbers we need to get the company value. The resulting figures, which are displayed on the screen, will be used in our calculations. Please note that these figures are based on assumptions and this is not a financial advice. Thoroughly research any stock before making an investment decision. With these revenue and profitability estimates, we can calculate valuation ranges using common methods like discounted free cash flow or enterprise value to EBITDA multiple. So let's look at numbers we got from estimates we just put in place. First up is enterprise value to revenue metric for 2026. Based on projections, this comes in at $210. However, with a margin of safety applied, the price falls to $195. Next, we have our first valuation model, which uses a 5-year projection with a perpetual growth valuation coming in at -$90. This is because Dollar General's debt outweighed its cash position, and the company isn't expected to generate enough cash in the next 5 years to fully cover its debts. Second valuation here is enterprise value to EBITDA, which comes in at $145. Our second valuation model is based on 3 years projection. This model yields a perpetual growth valuation of -$111 and an enterprise value to EBITDA valuation of $170. This also highlights the variability in estimates depending on the time horizon used. Moving on to free cash flow analysis. We use two different perpetual growth models. The first one uses EBITDA, depreciation and amortization, CapEx, and changes in net working capital. This gives us a value of $1.17, while the second valuation, which additionally to the first one also accounts for interest and debt discounting, results in a value of $35.86. Combining all these valuations, we get an average price of $49 and $34. Now, let's move on and look at the same valuations but for industry averages. Enterprise value to revenue for 2026, this valuation comes in at 285 with a margin of safety already applied. Next up is the same value 1 model for the next 5 years, where perpetual growth is the same as we are operating with the same numbers, but enterprise value to EBITDA estimates adjust to $130. The same applies to value 2, where enterprise value to EBITDA adjusts to $151. Averaging these values together with unleveraged free cash flow brings us to 57.37, so slightly higher compared to the company averages. Analyst estimates provides additional perspective. Here we use free cash flow based on its past performance and analyst estimate. A 5-year analysis comes in at -$3.5 and a 3-year one comes in at 12.7, with enterprise value to EBITDA multiple coming in at 169. Then we have two free cash flows from operation models, one based on revenue, which comes in at $29, and the second one that is based on net income and comes in at -$77. Last in this segment is free cash flow multiple, where we take an average of free cash flows over the last 5 years and multiply it by 20. Here, no margin of safety is applied, and we get a price of $131. If we average all this up, we came in at $43.65. Finally, we calculate a terminal value using revenue-based scenarios with dividend payouts. The average value comes to $130. By combining and averaging all mentioned numbers across all models, we arrive at a blended valuation of $57.97. At this valuation, Dollar General's trailing 12-month PE is 9, with a forward PE being at 10. To put this into context, the lowest PE the company has seen in the past decade was 10.43. If our assumptions hold true, this would mark an all-time low of a PE for Dollar General, so getting it below this valuation would, in my mind, be a great investment. Now let's also briefly touch the dividends. Currently, a dividend yield hovers around 3%, with a current payout ratio at 31%. The payout ratio is set to rise to 41% the following year, based on the income we calculated earlier, and fall to 39% in 2026 if they maintain the current dividend payout, meaning that the dividend is well covered and sustainable in my eyes. Dollar General also repurchased almost 4% of its shares annually for the past 5 years. Based on all of this, I would consider buying Dollar General once it falls below $70. At this level, PE would be at 10.88, slightly above the historical low, but still a reasonable entry point. Currently, we are close to this price, so I hope that we see an additional correction so I'll be able to grab some shares. If our assumptions are correct and the price of $70 is reasonable, then we can expect a return of 6.35% if we buy the stock at current levels. If we include the dividends, the return rises to 9.5%. If you believe the price should be $60, then the return would be 3% based on stock movement alone and 6.2% if we include dividends. For all of those who made it until here, I also have one bonus for you. If you believe that the numbers on the screen are more in line with your thinking about Dollar General, then the price moves down to $50. This means the return would be negative 0.5%, and if we include dividends, then return would be 2.5%, meaning Dollar General is not a buy at the moment. That wraps up today's valuation of Dollar General. What are your thoughts? Do you agree with this price target or do you see things differently? Let me know in the comments below. And don't forget to like, subscribe and hit the bell for more insights like this. Thank you for watching and I'll see you in the next video.